Hey, welcome. Today, we're not just talking about investing. Nope, we're handing you the architectural blueprint to build a stronger financial future. This is all about asset allocation, which, believe me, is the very foundation that can make or break your entire journey in the financial markets.
So let me ask you a question. When you think about investing, what pops into your head? Is it like a grand chess match? A game of pure skill and strategy? Or does it feel more like you're just rolling the dice at a casino, hoping for the best? Look, that feeling of uncertainty is totally normal. But what if I told you there's a way to stack the odds in your favor? And that feeling right there brings us to the biggest risk of all, the risk of simply not knowing. The antidote to all that uncertainty is something we'll call investment knowledge, and it is the key to turning that gamble into a truly calculated plan. So, what exactly is this investment knowledge? Well, you can think of it as your ability to look at any financial asset, really understand its DNA, figure out its potential rewards and its hidden risks, and then strategically put your money to work to make it grow. See, this isn't about guesswork, it's about building a portfolio that can weather the storms, not one that creates them. Okay, now that we get why knowledge is so important, let's open up the toolbox, right? To build anything, you need building blocks. And in the world of investing, we call these the asset classes. First up, we've got equities, or what most of us just call stocks. This is what usually comes to mind when we hear the word investing. And when you buy a stock, you're not just buying a digital receipt. You're actually buying a tiny slice of ownership in a real company. And here's the classic trade-off with stocks. They offer this huge potential for growth over the long term, right? Through dividends and the stock price going up. But, and this is a big but, that potential comes with a price: high volatility. The value can swing up and down like crazy, and you've got to be ready for that ride. Next on the list, we have bonds. Now, if equities are all about ownership, you can think of bonds as being all about debt. When you buy a bond, you're not a part owner, you're actually a lender. You're giving a loan to a government or a big corporation.
And this is where you really see the contrast with equities. With bonds, the returns you expect are lower, sure, but they are way more predictable. You get these regular interest payments, and the volatility is usually pretty low. They're kind of like the steady, stabilizing force in your portfolio.
But you might be thinking, what if you don't have the time or, the know-how to pick individual stocks and bonds? Well, that is where investment funds come into play. Just picture them as these professionally curated baskets, already filled with a whole collection of different securities, and they're all managed for you. All right, let's step out of the financial markets for a second and into the physical world with real estate. This is all about investing in tangible stuff like land and buildings. And a really crucial thing about real estate is that it often marches to the beat of its own drum. It doesn't always move in the same direction as the stock market, which makes it an amazing tool for diversification. And finally, we have the really interesting and dynamic world of alternative assets. Now, this is a super broad category. It includes everything from commodities like gold and oil, all the way to things like private equity. The key here is that their value is driven by totally different factors. Think global supply and demand instead of company profits. This can add another really powerful layer of diversification, even though they can be a bit more complex. So we've got all these different building blocks, right? Equities, bonds, real estate. But the real secret to building a strong portfolio isn't just about picking the best blocks. It's all about how you put them together. And that brings us to the absolute cornerstone of smart investing, the power of diversification. We've all heard that old saying, right? Don't put all your eggs in one basket. Well, in the investing world, that is the literal definition of concentrated risk. Because if that one basket falls, you risk losing absolutely everything. But by spreading your investments, your eggs, across many different unrelated baskets, you're actually building a safety net for your entire portfolio. So a crack in one basket doesn't spell total disaster.
Okay, so let's get a bit more formal for a second. Diversification is the strategic process of allocating your investments across different assets, specifically to reduce your exposure to any single point of failure. It is, and I really mean this, probably the most important principle for managing the inevitable ups and downs of your portfolio. Look, theory is great, but let's see how this stuff actually plays out in the real world. We're going to dive into a little story, a tale of two portfolios so we can see diversification in action.
Let's meet investor A and investor B. Now, both of them start with 100,000 dirhams to invest, but their approaches could not be more different. Investor A is a risk taker, putting every single dirham into one promising stock. But investor B, Well, investor B decides to diversify that 100,000 dirhams across a bunch of different asset classes. And here's a look at Investor B's strategy. It's a carefully balanced portfolio, 40% in stocks for that growth potential, 30% in bonds for stability, another 20% in real estate, and 10% in commodities. It's a textbook example of a smart, diversified approach. And then it happens. The market hits a really rough patch, and the stock market just plunges by 30%. So let's see how our two investors are doing now. For investor A, the outcome is, well, it's swift and it's painful. Since their entire portfolio was tied up in that one asset class, their 100,000 dirhams is suddenly worth only 70,000. That's a direct 30% loss. Ouch. But now let's check on investor B. Of course, their stocks also took that 30% hit. That $40,000 in equities dropped down to $28,000. But here's the magic of diversification in action. Look at the other assets. Their bonds, their real estate, and their commodities. They all held their ground, acting like a giant shock absorber for the portfolio. And the final results, well, they really speak for themselves. Investor A is left holding 70,000 dirhams, but investor B, who is shielded by diversification, ends up with over 88,000. That diversified portfolio acted as a powerful defense against the market storm. So, after all that, what are the big takeaways here? What do you really need to remember? Let's boil everything we've talked about down to 3 core keys for investing. It really all comes down to these 3 things. First, take the time to really understand the unique characteristics of each asset class. Second, know their individual risk and return profiles inside and out. And third, and most importantly, use the power of diversification to combine them strategically, so you can create a more stable and resilient portfolio. At the end of the day, you now have the blueprint for building a much more robust investment portfolio. The foundational principles are clear, so the only real question left is, how are you going to design yours?